Welcome back to the Deep Dive. So today, we are tackling the Freelancer Tax and Compliance Handbook for the Philippines. And I have to be honest, this is one of those topics I usually try to run away from.
I get it.
There's this massive misconception that freelancing is just, flying under the radar, right? You get your cash, do your work, no boss, no rules.
It's a lovely fantasy, but the reality is the moment you step out of a typical job, you're not leaving the legal framework. You're just stepping into a much more complex one.
And treating it like the Wild West is a bad idea.
The fastest way to get into serious trouble.
So our mission today is to decode that framework without putting everyone to sleep. We need to figure out the real difference between a freelancer and an employee, this whole worldwide income thing.
That one confuses everybody.
And how to actually pay the tax without losing our minds.
We'll keep it practical. Because understanding this isn't just about avoiding penalties, it's about professional legitimacy.
Let's start with that first point then, identity. How does the law actually know if I'm a freelancer or an employee? Is it just what's in the contract?
Not at all. The law looks at the substance, not the label. They use something called it's the fourfold test. Right. They look at selection, wages, dismissal, and the most critical one of all is control.
Right, but control sounds so vague. If a client gives me a deadline, is that control? Are they my boss then?
Not necessarily. The law looks at how the work gets done. So think of it this way. If I hire you to paint my house and just say, make it blue by Friday, you're a freelancer.
I choose the paint, the brush, all of that.
Exactly. But if I stand over your shoulder telling you to use a 3-inch brush, start from the left corner and stroke upwards.
And then you're dictating the method.
You're dictating the method. That is control. And in the eyes of the law, that makes you an employee, no matter what that contract says.
Which creates a total mess for liabilities.
Mm-hmm.
Okay, now for the part that really trips people up. I'm coding for a startup in Toronto. They pay me in Canadian dollars into my PayPal. Surely the Philippine government has no claim on that.
You'd think so, wouldn't you? That is the worldwide trap. If you're a resident citizen, the tax code doesn't care where the money comes from.
It cares where the work happens.
It cares where the work happens. They call it situs, or a site of taxation. If your butt is in a chair in Quezon City while you code, that service is performed in the Philippines.
So it's Philippine-sourced income.
And it's taxable?
Well, that bursts that bubble. So if we have to pay, what are the options? The handbook mentions a kind of menu of tax regimes.
It does. And there is a simple option. The crowd favorite, I'd say, is the 8% option.
See, 8% option.
If your gross sales are under 3 million pesos, you can choose to just pay a flat 8% on everything you earn over 250,000 pesos.
That sounds incredibly straightforward.
It is. It replaces your income tax and the percentage tax. It's perfect for writers, designers, anyone with low overhead.
But what if I have high expenses, like I'm renting an office, paying for software, but I also hate tracking every single receipt? Is there a lazy version?
Yes, and it's called the OSD Optional Standard Deduction. Instead of giving the BIR a shoebox full of receipts, you just take a flat 40% deduction from your gross income.
No questions asked.
None. It's a bit of a blunt instrument, sure. You might save less than if you itemized everything, but you buy back a lot of sanity.
Sanity is valuable. Okay, speaking of sanity, let's talk paperwork. I see freelancers making these beautiful invoices in Canva. Is that enough?
For getting paid by a client, maybe. For the tax man, absolutely not. An invoice is just a bill.
Right.
To prove you received the money, you need an official receipt, an OR.
And if I just stick with my pretty Canva PDF?
If you get audited, those PDFs are basically invisible. The BIR will assume you never issued a receipt, which comes with a massive penalty.
Wow. Okay. And quickly, what about Form 2307? I hear complaints about that all the time.
Think of Form 2307 as cash. It's a certificate that proves a client withheld some tax from your pay on your behalf. You use it to lower your own income tax bill.
So if you lose it, you're just throwing away money?
You are literally throwing away money you've already paid.
So kept the forms, print the real ORs, and know your status. It sounds like compliance is less about just following rules and more about building a shield.
That's the key takeaway. It protects you. Hey, speaking of protection, here's a final thought for you to mull over.
Okay.
If the BIR ever does come knocking, they can't legally audit you without something called a letter of authority, an LOA.
An LOA.
It's a very specific document authorizing that specific audit. If they don't have one, that audit has no legal leg to stand on. Knowing your procedural rights is just as important as paying what you owe.
Don't just pay the tax, know the rules of the game. That's a great place to end. Thanks for helping us figure this out.
Always a pleasure.